California Dream for All program is opening up again on February 24th. And if you're thinking about buying your first home in California, this could be the most important information you hear all year. The California Housing Finance Agency has allocated between $150 and $200 million in funding to help approximately 2,000 families become homeowners in 2026. I am Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. This program is fundamentally different from traditional down payment assistance. California Dream for All offers up to 20% of your home's purchase price in down payment assistance capped at $150,000, whichever is less. This assistance comes in the form of a shared appreciation loan, which is a 0% interest loan with no monthly payments. You only repay it when you sell the home, refinance your first mortgage, or pay it off completely. Now, here's where strategy becomes critical. The program has two distinct income categories, and which category you fall into determines their three major factors: your minimum credit score requirement, your first mortgage interest rate, and the percentage of appreciation you'll share when you eventually sell. Let's talk about income thresholds for the major Southern California counties. In Los Angeles County, the maximum income qualify is $168,000. In Orange County, you can make up to $216,000 and still qualify, and San Diego's limit is $207,000. Riverside and San Bernardino counties have identical limits. If your household income is at or below $109,333, you're in what's called the low income category. Between $109,333 and the maximum of $164,000, you're in the moderate income category. If you're buying in any other California county, reach out to us and we can provide you with the specific income limits for your area. Now, why do these categories matter beyond just qualifying? If you're in the low income category, meaning at or below 80% of area median income, you receive three substantial advantages. First, your minimum credit score requirement is 660 instead of 680. For families working to rebuild their credit, those 20 points can be the difference between qualifying and not qualifying. Second, you qualify for what Cal HFA calls their low income interest rate on your first mortgage. This is a reduced rate compared to the standard rate that moderate income borrowers receive. Over the life of the 30-year mortgage, even a quarter point difference translates to thousands of dollars in interest savings. Third, and this is perhaps the most significant long-term benefit, you only share 15% of your home's appreciation instead of 20%. This is calculated on a 0.75 to 1 ratio instead of 1 to 1 ratio that moderate income borrowers face. Let me explain what that means in practical terms. Say you purchase a $500,000 home and you receive the full 20% assistance, which is $100,000. 5 years later, your home is worth $640,000. That's $140,000 in appreciation. If you're in the moderate income category, you share 20% of that appreciation, which is $28,000. You'd pay back the original $100,000 plus $28,000 for a total of $128,000. If you're in the low income category, you only share 15% of that appreciation, which is $21,000. You owe back $100,000, the original assistance, plus $21,000 for a total of $121,000. That's a $7,000 difference that stays in your pocket. And if your home appreciates more significantly, that difference becomes even larger. Now let's talk about the eligibility requirements. First, you must be a first-generation home buyer. Cal HFA defines this very specifically. You cannot have owned a home in the last 7 years, and your parents cannot currently own a home. If your parents are deceased, they cannot have owned a home at the time of their death. There's one important exception. If you were ever placed in foster care or out-of-home institutional care at any time in your life, you're automatically exempt from the parent ownership requirement. You still cannot have owned a home in the last 7 years, but your parents' ownership status does not matter. At least one borrower on the loan must meet this first-generation requirement. But here's the critical part. All borrowers on the loan must be first-time home buyers. Cal HFA defines a first-time home buyer as someone who has not owned and occupied a home in the last 3 years or someone who has never owned a home before. So CalHFA says 3 years, and the Dream for All says 7 years. You must also have at least one borrower as current California resident, and the property must be your primary residence. Now let's talk about the application process. This is not first come, first serve. Starting February 24th, 2026, and running through March 16th, 2026, there is an application portal that opens for registration. During those 3 weeks, you register for the opportunity to receive a voucher. After March 16th, when the portal closes, CalHFA conducts a random lottery selection. It doesn't matter if you registered on February 24th or March 15th. Everyone who registers during the window has an equal chance of being selected. After the lottery, CalHFA will email applicants one of 3 statuses. You received a voucher, you've been placed on a wait list, or you were not selected. If you receive a voucher, you have 90 days to find a home and reserve your funds. You can request one 90-day extension if needed. Here's the critical part. You must have a pre-approval letter from CalHFA, from a CalHFA approved lender before you can even register in that portal. Yes, our team is a CalHFA approved lender. So you got to have the pre-approval letter from us before you can even register in the portal. This isn't something you figure out after you're selected. You need to be fully pre-approved with your credit pulled, your income documented, and your lender confirmation in hand before you go into the portal before February 24th. This means the work starts right now. You need to get your credit report and review it for errors. You need to gather your income documentation. If you're self-employed, that means 2 years of tax returns. If you're W-2 employed, that means recent pay stubs and W-2s. You need to understand your debt to income ratio and make sure you meet the minimum credit score requirements. The program also requires completion of CalHFA's home buyer education. This is a 1-hour online course that's free and covers what shared appreciation means and how it affects your mortgage. Let's talk about the loan structure. The minimum combined loan to value ratio is 95%. The maximum is 105%. What this means is that you can only contribute a maximum of 5% of your own funds toward the down payment. The program is designed to help people who don't have significant cash reserves. The shared appreciation loan must be second lien position behind your first mortgage. You cannot use this assistance to pay off existing debt. The funds must go toward down payment and closing costs. Here's something important. You can refinance your first mortgage one time and resubordinate the Dream for All loan without having to pay it back. This means if interest rates drop significantly in a few years, you're not locked out of refinancing. However, you can only do this once. After that first refinance, any subsequent refinance would trigger repayment of the shared appreciation loan. When you eventually sell or refinance, you must repay the original assistance amount plus your share of the appreciation, or their share of the appreciation. If your home is not appreciated or if it's declined in value, you only pay back the original assistance amount. You don't owe additional money if there's no appreciation. That's the risk CalHFA is taking by partnering with you in this program. There is a cap on shared appreciation at 2.5 times the original loan amount. So if you received $100,000 in assistance, the maximum appreciation share you could ever owe is $250,000, regardless of how much your home actually appreciates. Now let's address the strategic question. Is this the right move for your household? We need to evaluate everything through the lens of safety, liquidity, and return. From a safety perspective, you're taking on no additional monthly payment burden with this assistance. The shared appreciation loan has no monthly payment, so it doesn't affect your household cash flow from month to month. From a liquidity perspective, this program allows you to become a homeowner without depleting your savings. You start building equity now instead of waiting years to save a down payment. From a return perspective, you're giving up 15 to 20% of your appreciation depending on your income level, but you're also avoiding private mortgage insurance by putting at least 20% down between the first mortgage and the assistance. You're also potentially benefiting from home appreciation over the years you would have otherwise been saving. This is why strategy beats rate always. It's not just about getting the lowest interest rate on your mortgage. It's about understanding the complete financial picture, the timing implications, and how this assistance program fits into your long-term wealth building strategy. Let me address a few common questions. First, what types of properties are eligible? The program works for single-family residences, townhomes, approved condominiums, and manufactured homes on permanent foundations. It must be one unit property that you'll occupy as your primary residence. Second, there is a sales price limit. Is there a sales price limit? No. As of 2020, CalHFA eliminated sales price caps on eligible properties. You must meet the income limits, but there's no specific price cap on the property itself. Third, can you combine this with other assistance programs? Generally, no. The Dreams for All assistance cannot be combined with CalHFA's My Home Assistance Program or most other down payment assistance programs. CalHFA has set aside between $100 and $200 million for this round of the program to help approximately 2,000 families or households. Following direction from Governor Newsom, at least 10% of the funding is reserved for applicants living in qualified census tracts. The reality is the demand will likely exceed supply. In previous rounds, the program has been significantly oversubscribed. This is why preparation is so critical. You can't control whether you get selected in the lottery, but you can control whether you're ready to move forward if you are selected. Here's what you need to do right now. First, go to rsrlinks.com/keysteps. rsrlinks.com/keysteps. That's our financial house in order tool. It'll walk you through exactly what you need to review, what documents you need to gather, and what your credit picture needs to look like. Second, rsrlinks.com/FTHB for California specific first-time homebuyer resources and guidance. You'll need to pull your credit report and review it for errors. You need to determine which income category you fall into and what that means for your credit score requirement and your shared appreciation percentage. You can do that at rsrlinks.com/FICO. rsrlinks.com/FICO. You need to find a CalHFA approved lender. You already have, that's us. And get your pre-approval letter completed before February 24th. This isn't something you can figure out in the last week before the portal opens. The families who successfully navigate this program are the ones who start preparing in advance. They know exactly where they stand financially. They've addressed any credit issues. They have their documentation organized. They understand the program requirements. They're ready to move quickly if selected. Remember, this is about strategic debt management and positioning your entire financial picture for long-term wealth building. The Dream for All assistance is a tool, but like any tool, its value depends on how you use it and whether it fits your overall structure. Remember, the portal opens February 24th, closes March 16th. That's your window. Make sure you're ready. For comprehensive preparation and to get your financial house in order, visit rsrlinks.com/keysteps. Again, for the first-time homebuyer resources, go to rsrlinks.com/FTHB. I am Ron Siegel, your certified liability advisor, helping families build wealth through strategic debt management. Thanks for listening to Mortgage 101, brought to you by rsrlinks.com/FTHB, rsrlinks.com/FTHB.